No. Where have you come from? Where are you going?
Yeah, sure.
I will always love you. And I don't know. Like, my name is Lisa Illingworth, and I am the commercial director for Raise. I have been a previous founder of a business and stepped out of the operations of that business in order to join Marvin and Raise in order to solve some big problems for Africa. And it's been an exciting journey up until now.
That it has. My name is Marvin. I'm one of the contributors in the role of CEO at Raise and a co-founder, working especially closely with Lisa and the team. Yeah, CEO and co-founder of Raise, and a big part of our role is equity structuring for startups to remove the barriers of growth for this ecosystem. There's all legal barriers to companies growing, and we spend our time removing them. So we're a SaaS platform that provides companies and startups in the ecosystem building tech solutions, primarily in Kenya, Nigeria, and South Africa, with the ability to structure their corporations, understand how licensing works, and most importantly, structure their equity ownership between the founders, the shareholders, and the teams in such a way that they accomplish their objectives. And our thesis is that if companies understand and get better at just understanding how equity works, they can band together to solve all these hard problems we need to solve across our continent, and then we have a chance of building the ecosystem we're proud of. So we provide a variety of products and solutions, but primarily through one platform, which we refer to as Raise.Africa. Like any other startup, it starts as an idea. The original idea and still the vision is to build a stock exchange across Africa where people can plug in, buy all kinds of different stock. And the thesis is that functioning capital markets are incredibly important to the African continent's growth in different countries, different sectors, different things, and most governments are dependent on them. And they need to be rebuilt from scratch. So that was the original idea. And since 2017 to now, just been iterating and building on different versions of it to where it is now, which we'll tell you about. But that's the primary thesis that gets us going, is that if we're going to rebuild the African continent, we need as many startups as possible to survive. And we're a startup that helps other startups. So we like to think we play a unique role in this ecosystem.
In fact, that's encapsulated in one of our straplines, Raising Africa One Startup at a Time. As a startup ourselves, we understand deeply what it is to try and grow a business in a blended economy which exists across Africa and the challenges that are faced within that. And our mantra across the business is to raise effective, sustainable businesses, particularly around equity structuring, so that there is a skeleton for growth for startups in Africa.
I take it.
Go for it. Yeah.
We work primarily with seed to Series A companies, and we worked in the past a lot of pre-seed companies. And the market of African tech companies is about $20 billion invested into companies at different stages, different sectors, in different countries. And our primary focus is like that. We talked about it earlier, right? Seed to Series A companies, just because less and less of them, but us are able to make it past that. And a big part of that reason is just understanding around equity literacy, how that works, how you build a skeleton for a company to grow. That's how big the market is. So $20 billion invested into companies. If we assume that those companies have a valuation of 2 times what they raised, which is probably not true, but just so we know, that's a market of $40 billion worth of African tech companies, optimistically. But the size of companies we service, like that market, is a couple $100 million.
Okay, so the primary platform that Raise provides, or the product that Raise services the market with, SaaS-based platform as mentioned before. It has 3 tenets to it. The first is being able to organize businesses. So we form 3 problems, or we postulate that there are 3 problems that founders face when it comes to building sustainable businesses. And the first is that they can't organize their businesses effectively for growth. So Raise solves that problem first, and that's using a SaaS platform in order to do that. So putting together structures around equity ownership, shareholding, as well as investment channels into businesses that allow businesses transparently to grow on that. So this is the Raise platform to start off with. Coming soon, and I want to use my movie voice, is the ability to organize your talent and the ability to organize your capital effectively as well. Because that's often where startups in Africa suffer the most with growth, is that they get into markets, they get customers, they acquire market share, but the internal structuring around the organization of their business, the organization of their capital, the organization of their talent then becomes the critical points at which they fail. So as a platform exists in order to serve those three things. Then layered on top of that are the services that we bring to the market as well. So internally, the team then has 3 different ways of servicing the businesses around them, and those on the platform. The first is through what we call an equity clinic, and that's being able to do a deep dive into the structures of equity that currently exist in the businesses, being able to spot the gaps and then help founders rehabilitate the equity of the businesses and give them a corporate health score by which they can measure the health of the equity. We then offer valuations on top of that, being able to enable businesses to unlock capital into their companies. And then coming soon, again in my movie voice, is then the services around legal structuring. So nice basis of platform with SaaS offering, and then on top of that, layered services as well. So it's not coming soon. It is being used currently. It's not something that we advertise in particular as one of those, because then we would turn the business into a marketplace. And Raise isn't a marketplace, but what we do have is an amazing network across Africa of investors, and those are investors that have invested into Raise, as well as a network of investors that exist in the ecosystem that we serve. And then we have startups as well that we serve in terms of that. So we don't advertise it as one of the services that we offer, but I think it's definitely a value add, being able to connect people in the marketplace to one another, because it serves what we do, raising Africa one startup at a time.
Ideal startup?
Yeah.
That's a hard question. I don't even know what ideal startup looks like, but I would imagine it's a company that, even if it's just an idea, you set around a skeleton, equity structure, corporate structure, even compliance, to be able to experiment and then scale that idea. So I always taught that as a lean methodology for startups, right? You build a small thing and you keep going. That's still very much the case. But especially in this ecosystem, we leave behind all of the important work that needs to be done. And fortunately and unfortunately, the corporate structures that companies have at a really early stage in this ecosystem are relatively complicated. You'll have a Delaware company and multiple Nigerian entities. I was just talking to a company that had like 6 different subsidiaries. Whereas I don't think we realize in most other markets, they have like 1 to 2 companies max. So the level of complexity you have to deal with is relatively small. And most data shows that most startups don't hire a legal internal resource until Series A, if that. And this ecosystem was still too small and too young to have a really large roster of financial and legal talent to kind of organize a lot of this stuff. So it's kind of falling on the founders to do it, and most founders don't know this stuff, or they're doing it for the first time and they don't have the resources to. That's what a good company looks like. A company that takes the time to organize that stuff effectively before they grow. We see that more common with second, third time founders, not first time founders, for obvious reasons, but that's a good company. Looking at the idea, looking at traction, but looking at equities well organized, you can explain what the next step is in the company's growth and how that maps back to everybody's ownership. Because like Lisa was saying, the organized part we are relaunching is a collection of different tools that automate a bunch of different boring legal and financial operational things, right? A collection of different tools, but really what they're meant to do is to organize people to achieve a certain outcome that is measurable, typically on the cap table. And that's why we call it organized.
I think the most foundational element that you would need is your cap table, or at least some semblance and understanding of how your equity is structured. And that's the foundational document of which we start with. So if you're coming with some understanding of shareholding structures and potentially investment structures that you want to build towards, that's the primary documentation or criteria that we look for. And we base then your profile, your account build on the platform off of that. If a company doesn't necessarily have that, it's also something that we can work with founders in order to build. And we have templates of best practice in order to supply to founders and help them work through that process if they're coming in at a pre-seed level and they haven't done a raise before. So we're really looking to work with decision makers, first of all, in the business, because then that speed to value happens so much faster for the company. We're able to supply services. We're able to step in and advise founders on how best to structure that and work with them on cleaning up their cap tables. In fact, it was actually a founder I was speaking to recently at Africa Tech Summit who turned around and said, I've issued shares to people and I don't even know what the values are now because I've issued shares to all kinds of people and where they sit, I have no idea. So at least coming with some semblance of, all right, this is where I stand, with a realistic picture of where I stand, not an unrealistic picture, which often founders do, and then being able to use that to structure a cap table as just a foundational platform for growth. And then if they were to go through the equity clinic, understanding where's your shareholding, where are you incorporated, what documents would you need in order to get your equity health score up, it's kind of just where we would start with a business if they're coming in at pre-seed level and they haven't done any of these things before. But we also often find companies coming in at seed and Series A levels who are still struggling with these things. They've grown so fast. The injection of money has happened at such a rapid pace that they're scrambling to fix it.
To fix at that stage.
Yeah.
And the companies to ideal company and criteria together, we're getting better at targeting different companies because it's cookie cutter. Like companies of certain sectors, of certain industries, of certain sizes and stages in Africa will have pretty much the same problems, and those solutions are working better for them. But the companies we really spend more time looking at now is companies that have raised at least $1 million, so $1 million up to like 50 million. That's kind of the bracket in this ecosystem. Just because most of it is in safes, which is a kind of investment agreement, and it pretty much forces companies to kind of get to Series A level. And we talked about it earlier. At one time in this ecosystem, there was a 60% chance of going from seed to Series A, which signals a product market fit. That was before a venture capital downturn. That was before all of this inflation hit this market. And that was before African tech lost kind of like that hype and stuff like that. So willing to bet is less than a few single digits now, which means that the chances of getting from an idea to a fully sustainable growing business is significantly smaller than it used to be. And a big part of that blocker is the licensing, is the diligence, is the corporate governance we've seen in this ecosystem a lot more. It's the financials, all those different things. And when you asked about matchmaking earlier, there's a reason we don't do that as much, just because everybody else does that. Like it's not hard to find investors in the ecosystem. They're around. There's like list of it. But even them, they're looking for very quantifiable legal financial information to make an investment. And that infrastructure seems to be missing in this ecosystem.
And I think what we've seen in terms of trends as well is that there was a mass investment of venture capital into Africa around that hype. But even venture capital investors are starting to get more picky about who they invest in. They're starting to filter down into the diligence levels of businesses that they want to be involved with. And not having proper equity structures in place is going to be one of those first gateways that companies need to cross in order to access those pools of money. Oh my goodness, absolutely yes. Yes.
Capital formation is about organizing a company to get to a certain outcome. And remember we said earlier, right? Like in a startup lean methodology, those founders are not really thinking of an exit because it's just an idea. Like it's just experimenting a couple of different low-code solutions. But there's a lot of companies ecosystem that have to meet unreasonable targets to be able to make a return. And given how little of a chance it is to get there now, it's becoming harder. So for example, about $520 million went into seed stage companies, period, since the beginning of this ecosystem. Let's say generously 10% of them actually make it to the next stage and they grow 5x. That's even less than the amount of money that was invested in seed stage, period, like less than half. So we're already losing money. It just doesn't look that way when all of the articles are about fundraising and raising money. But there's a serious ecosystem-wide financial issue at the equity level, and that's what we solve.
I think I liken it to building a house. When you're building a business, is the base level, the foundations on which the house is built are those levels of structuring, governance, compliance levels. If those are in place, it provides that foundation so that whatever growth happens on top of that, it happens sustainably. A lot of businesses go to market with an idea, they get market feedback, they get first customers, they're all excited, they get traction. The compliance and the governance for most founders who are excited by novelty, that requires diligence. It requires habitual practice. Habitual practice is not fun for founders, and so it gets ignored in the face of market traction. We'd much rather go after the market and customers and revenue in the bank than focus on how do we build these sustainable foundations for growth. It's only when the foundations suddenly come under the spotlight, either by the media or by venture capital investors, is that now taken into account. And sometimes in this ecosystem, it's too late. It's too late. The cracks in the foundations are already showing, and the growth structuring is shaky. And we've seen it in our ecosystem, how some of that has crumbled.
And they report on it all the time. You've seen it as much as we have, right? And typically we know about those things way before they become public, because we see a lot of deal rooms and cap tables, and that's part of the reason we move so secretly, just because privacy and confidentiality. But there's a lot of issues in this ecosystem at the equity level, and people's return on investment is not because you hit a certain amount of users. It's because the legal infrastructure of the company can support you selling. And we're going to talk about Web3, I'm sure, at some point. The entire space is built around how you incentivize people to do things. And unfortunately, like the way this ecosystem, the first foundations were built, is based on incentives that prioritize hypergrowth over sustainable businesses. And the continent doesn't meet that.
No, not sometimes. All the time.
I think there's a false assumption that investment is going into Africa's countries because people trust the local capital markets ecosystem. That could not be further from the truth. Truth is that there's tech companies, which is a very specific asset class, which has a very specific style of investing, which does prioritize hypergrowth over revenue, especially in later early stages. And yeah, man, that's what happens when we adopt another system and hope that it works here. And no one was really intentionally thinking about the next 50 years in venture tech in Africa. I think people just needed to find money and cash to grow. And it came with all these ugly surprises.
I think the one thing that supports that is the re-entry rates. If you look at the re-entry rates after failure for entrepreneurs in the States, it's 4 times. The average entrepreneur re-enters the entrepreneurial ecosystem 4 times after failure. In Africa, it's once.
The room for mistakes is small. I mean, we live this every day. We all hear, right? Like the room for mistakes and margin for error is extremely small. But we make mistakes every day. It's just a reality. But failing like a company is a hard thing to do, especially out here, because then it's just like, what do I do next, you know? Where do I find a reason?
So this market cannot afford to grow on shaky foundations. We don't have the tolerance for it. There's no margin for this. Well, I'll just start off at a high level, and valuations is the perceived value of the business from multiple stakeholders. And I think that's the portion that a lot of people forget. It's the multiple stakeholders and multiple views. So looking at what is a stakeholder, first of all, the market is a stakeholder in a valuation. The founder and the team are a stakeholder in the valuation. And then those that are perceiving the value of the business from the outside with the interest in potentially getting invested into that business. So that multi-level view of a business and the perceived impact and growth, and I want to say both of those because some businesses have purpose and profit, but impact and growth in the future brings about a value. And from Raise's perspective, and Marvin will go into the different ways of valuations and how it can be handled, the methodologies of it. From Raise's perspective, we're not here as a business in order to ramp up the value of a business in order for it to generate attention. We're taking a view of saying we'd like to position founders to grow sustainably. And one of the mechanisms of being able to grow sustainably and unlock that sustainable growth is a valuation taking into consideration the multiple stakeholders inside and outside of the business. You want to add?
It's a good description. The valuation helps you understand what a bunch of people make up is the value of a company based on patterns and trends and other things. And in this ecosystem especially, everything is being valued in US dollars. So when we talked earlier about the size of the market, $20 billion invested, that's trillions of shillings. That's a ton of naira, you know what I mean? So USD valuations are important and the valuation is important, but the way by which those valuations are being created, whether high or low, depend on a lot of different factors. So for example, if we took a bunch of logistics companies in Nigeria, for example, and all value them at a certain valuation, that may or may not be doing a disfavor to the entire logistics industry in Nigeria. So the way by which we go through doing valuation, third-party providers, research, markets, all kinds of different things is intended to arrive at a price for a single piece of equity that aligns with the growth trajectory of that country, that region, or that sector.
And it can start at a very granular level. So it happens at multi-level. So it would start off with the founder, the idea, and the current market traction that they've got. So potentially book of clients that they're sitting at the moment. You would then go down a level and look at the team that's available to support the founder and to support the growth underneath it. You would then go into a level of diligence. How is the company structured in order to grow and defend that market position? Is there IP that's protectable? Is there a market niche that's been carved out that can be sustained for 5 to 10 years? You would then look at, right, what are the macro factors that support that growth, the volatility in the market, and if there are any other proven cases that you can base a valuation of growth on top of that, or a projection of growth. You would also look at things like financial forecasting. Is there a revenue model that has shown traction previously that can grow into multiple markets, not necessarily in a single jurisdiction, but other jurisdictions around that? Is there a macro factor of volatility based on currency? We're seeing it at the moment, right at this time in Nigeria, where the volatility just in the economic state would have an effect on valuations of businesses that are operating in those markets. So you would start at a very granular level, an internal level, and you would expand that through into what are the other risk factors around the business that would influence that growth, that founders might not have any control over.
Yeah. Yes. We a big part of our thesis, remember, raising Africa one startup at a time. One of the many problems we solve is that there's a very big disconnect between how capital markets locally function and how venture-backed companies function. And a big reason that's happening is because most of the later stage financings are typically done by funds and institutions that are not based on the African continent, and their valuations are based on comparables with their economies, not these ones. So how do you build valuations, equity software in such a way that it builds companies to be sustainable and solves the problems they solve? So by sector, by region, by country.
Under local market conditions.
That's right, yeah.
Transparency.
A big part of the history of corporate governance across Africa and the diaspora has been mystery, poor practices, lack of transparency, financial mistrust. And a big part of this mission is to be sure there's too much transparency. Quite the opposite. So that's why you see the level of detail in there. If someone is taking that to an investor and investor is like, I don't think that makes sense, it puts the onus on someone else, a stakeholder, to basically present as much, if not more, data on why they think it's the case. And hopefully that creates a more responsible and accountable and data-driven ecosystem.
I think also adding on to that is to say that the majority of founders in Africa are potentially doing valuations for the first time. So there is an education factor in this as well, is that if we can educate founders better around valuations and what those actually mean for them, we don't just impact a single transaction. We impact an ecosystem. Because if your first idea is never your best idea, the reality is that the failure rate is high, that you as a founder are potentially going to go and start multiple businesses thereafter, if you're lucky enough to recover from your first failure. But you'll be going into the next business having those lessons under your belt. And so we take a long-term view as opposed to a single transactional view.
Yeah. I mean, all this stuff is made up anyway. So an idea is like, you could totally value an idea. Just like you value a late-stage company, what you're really valuing is the ability to execute. The only difference, still an idea. No one else has done it. But you're valuing the ability to execute, which is a lot more measurable now, right? So an idea could totally be measured, but the valuation should be a lot lower.
And I think there are a whole ecosystem. Silicon Valley has been literally based on people seeing value in ideas.
Sure.
Right?
And a lot of it.
Yeah. And then putting money behind it. I mean, the obvious is if you're coming out of something with a high valuation is that you've got perceived value with which to bargain. So if you would like to swap equity or potential future equity for that, you need to put a price tag against that. And if there is a high price tag, the capital amount that's invested into the business then increases. However, what a lot of founders do when they go after a high valuation is they underestimate what needs to be accounted for when you do have a high valuation. And we've seen it in our ecosystem, and what happens with that is there is an overinflated value on the businesses, and what it does is it turns the spotlight up from those that are investing.
Yeah.
It puts a level of accountability on the founder to justify that value that they've asked for.
And raise more money to get there. Hence why you see these numbers are so big in this ecosystem. Especially over here, man. Like, you raising the USD valuation, earning money in Naira. Like, that's a really high... That bar is literally getting higher every day as the Naira loses value. Same thing in Kenya, same thing in South Africa, all that stuff. So you're definitely doing a disfavor. Depending. So it's more of a science than it really is an art, is finding the right kind of like skeleton. And all of the structures, the legal information, the financial infrastructure companies should follow along achieving that path. So we encourage a lot of companies to do regular audits of their stuff. And that includes understanding the price of the company and how that grows over time. Yeah, Web3, DeFi, crypto, all those different kinds of companies have different ways of valuing and measuring themselves. We haven't created like a sectoral industry-specific version for crypto and Web3. If we did, I imagine it'll probably focus on payments, which I think is probably the most use case with the most traction across this ecosystem. And then other things after that, but it still remains a very difficult thing to do. Token economics work completely differently from how digital equity typically works. There's not a huge amount of Web3 companies in this ecosystem yet. We've only raised something like $200 million. So if you look at 20 billion have been raised, less than 1% of that went to crypto companies so far, right? But it runs differently for a lot of reasons. A lot of Web3 companies are still being funded by Asian investors, and Asia's capital markets and crypto markets have started to kind of like, not disassociate, but crypto will remain strong in Asian countries and independent of American capital markets. So that's why you see, even if there's a VC downturn right now, Web3 crypto companies in Africa, and you know this, are still raising money. It's the strangest thing. So we don't have a sectoral specific Web3 like valuation standard, just because the needs are so different. But we are looking at like licensing for those different companies, how you do OTC trades across. I was talking to a client just now, which just created a Zambian entity, has a South African entity now, and a Nigerian one, and they're running OTC trades across all of those markets at the same time. That is a huge legal financial lift, and most of it is not even legal. So it's like, how do you arrange a company in such a way they can accomplish that? So very much like the infrastructure level of these Web3 companies, but you know this better than anyone. Raise is a Web3 company hiding in plain sight. And the reason it is because when we talk about a Pan-African Stock Exchange, the idea is that it can become an infrastructure we use to predict things. So for example, when this VC downturn was happening, 6 to 8 months ahead of time, we started to see like what was happening on content, what was happening in tech companies in general, and even our valuation, we capped it. That was a good decision. Didn't look at a good decision at the time. It was now. And the reason is that like crypto, Web3 wallets, DeFi, all these different things provide and remove the complexity of financial transactions online, such as you could focus on building impactful things, software. And the idea here is that if we can find the right companies, the right sectors, at the right time, we could fund certain problems to fix them. But to do that, we first have to digitize all the stuff, which is why we don't talk about Web3 right now. But the idea is that we digitize this whole layer of equity, we price it, and then we put it on chain.
I think circling back to the point at the beginning is that this is all new to this continent. So people doing it for the first time, there isn't a lot of benchmarking. Alongside that benchmarking comes the regulatory environment which we have to exist and navigate at the same time. So any advice to Web3 businesses around valuations is do it often, because the regulatory environment, the compliance environment is changing so quickly, those macro factors will have an impact upon the valuation of your business.
Cal, that's about what Sachs raised Africa. So, in hopefully now.
Oh, it's now.
Okay, nice. There's a live web page by the time he publishes called raise.africa. Raise Africa. And the idea is that tagline, raising Africa one startup at a time. The idea is that for a while we've pitched ourselves as a cap table tool. And that's an important part for every company has to have one. That's the first thing. You're not at seed stage and you don't have one. If you are, then you've made tons of mistakes that are probably too expensive to fix. So the earlier the better. And the reason we pitch this Raise on Africa is just because this is more of an infrastructure than it is more business. It's not things that could just grow. And we've seen those cracks kind of form everywhere, right? They're happening almost weekly now.